All right, I don't want to waste any more time. We've given it a few minutes for everybody to join. Let's get this thing started. Hey, everyone, I'm Daniel Snyder from Seeking Alpha, and I want to welcome you to today's Staying One Step Ahead of the Fed. In just 24 hours from now, the Fed is set to raise interest rates for the fifth time this year in their attempt to cool down red-hot inflation, which continues to print new 40-year highs, right? We've seen it time and time again. We saw it in May. We saw it in June. And just yesterday after the close, retail giant Walmart cut their guidance due to inflation and inventory concerns. Well, why is that? Well, food and gas are necessities in our economy, and consumers will choose that over apparels and miscellaneous home goods any day of the week when they feel like they're in a crunch. We went from a world of just-in-time inventory to just-in-case, and management teams, well, they couldn't keep up with the pace of change. So now, while some certain outlets are saying that a soft landing is still possible, companies have already started to rein in their spending. And I'm not just talking about the, excuse me, give me one second. Just had a glitch. You guys still hear me okay? Great. Awesome. I'm not just talking about companies like Alphabet, Apple, Microsoft. We're also talking about companies like Shopify, who just came out this morning and said that they are ready to cut 10% of their workforce around the world days before they're supposed to announce their earnings, right? How crazy is that? Everybody is preparing for an economic slowdown coming down the road. So here's the question. Can the Fed really cool down the economy while avoiding sending the economy into a recession? Or is it completely out of their hands at this point and they're still trying to play catch up? They're trying to get their credibility back. And we're all sitting around waiting to see how bumpy this recession is going to be. Is it going to be shallow? Is it going to be deep? Does the inverted yield curves actually mean anything? I don't know. All eyes are on Thursday's GDP number, though, right? With so much news coming across the wire seemingly every hour, it's a good idea to take a step back and take a look at the macro view. So that's why we asked Eric Basmachin from EPB Macro Research to take the time and put together this presentation for you today. Eric is an economic cycle analyst whose proprietary frameworks are used by institutional and individual investors alike to help them make better decisions. So in today's webinar, Eric is going to break down what his models are saying is coming down the road in the next 6 to 18 months. And more importantly, how you can prepare for it with the names of 2 securities to put on your watch list today. Now, I've had the pleasure of interviewing Eric many times over the last year for our shows like Stock Market Live, We Can Buy, and other webinars. And I've got to tell you straight up, he has been right time and time again. He's even helped me protect my portfolio against the market drawdown we're seeing this year because he just drops massive amounts of value. And I expect today to be no different. So our team is going to go ahead and drop the link to his service in the chat box so you can check out everything they have to offer after the webinar. At the end of the presentation, Eric will take time to answer all of your questions. So feel free to type them into the chat box throughout the webinar, and we're going to get to those at the end. Now, before we really dive in and invite Eric here on the screen, I'd like to make sure everyone's looking at your screen so we can take a quick poll, because you know how we like to do it. We like to interact. So let me go ahead and throw this up on the screen. And the question today is, give me one second. Oh, looks like we have this on the other one. Give me one second, guys. Well, I'm just going to ask it for you because I don't see it anymore. How long do you think a recession in the United States is going to last? Why don't you go ahead and jump into the chat box with the answers? Do you think it's going to last less than 3 months? Do you think it'll be 3 to 6 months, 6 to 12 months? More than 12 months, or are we not going to have a recession at all? I see people coming in 2 to 4, 2 years, 2 years, 12, 6 to 12, 1 year, 3 to 6 months, 1 year, 18 months. We're seeing it across the board here, guys. 1 hour. I'm not sure that's right, but nice try. 6 to 12 months, 12 months, less than a year, 9 months, 2 quarters, 1 year, 12, 18, 2 years, 1 year, 18 months. I mean, we are seeing a wide range of opinions coming through the chat right now. 12 months. I keep seeing 12 months. Keep seeing 2 years in here a lot as well. 12 months, 1 to 2 years. That could be a very, very bumpy time. 18 months, 12 to 18 months. All right, guys. Well, that kind of gives you an idea, right? We're looking at a lot of people thinking that a recession coming down the pipe will result in a longer recession and not a shorter recession like everybody's starting to talk about. So without any further ado, I'm going to go ahead and invite Eric into the conversation here and hand over the mic so that he can run you through the economic cycle framework that he has to show you today. Eric, why don't you go ahead and jump on here?
Hey, Daniel, how are you?
Hey, doing well. Show's all yours. People are waiting to hear from you. Take it away.
Thanks. I gotta say before I get started, those are some good comments in the chat box. I was watching them as they were coming up. I saw one comment. I missed the name. They said, "Do you think the Fed is making a mistake between inflation and deflation?" And that's a really out of consensus comment, but I think that's a pretty astute observation. So I think as I go through some of my slides here, we may touch on that. I just thought that was a pretty good comment, something that you don't hear because the talk is all about inflation. We don't hear deflation anymore, right?
Deflation versus disinflation, right? We got to figure that one out first.
Exactly. Alrighty here. So I'm going to share my screen here. I got some slides prepared, and you let me know if you could see my screen here, Daniel, and then I'll get going.
Yep, you're all good to go.
All right. Thank you. So the title of this presentation is Staying One Step Ahead of the Fed. And I'm going to do my best to respect everyone's time here because I know that listening to slides can be a little boring. So I'm going to try and make this as concise and informative as possible so that we can get to the Q&A, which I really think is where a bulk of the discussion and back and forth happens. So this is called Staying One Step Ahead of the Fed. And in the next 20 minutes or so, I'm going to explain my economic process and how that translates to an asset allocation or finding the best assets for the current economic regime. I personally only use ETFs, but you can use this exact process to find which stocks to buy and when you should buy them. So just keep that in mind as you're listening. If you're more stock specific or individual stock focused, all of this information will still apply, but just know that my framework uses ETFs. I like to start my presentations with a little fun fact or a little trivia. So did you know that over the last 27 years, or since 1996, the S&P 500 has only gone up 42% of the time? Now, I know everyone is used to hearing that the market goes up 70 to 75% of the time, so I could already see everyone kind of rolling their eyes at that, but I'll show my work on how I arrived at that statement. So since 1996, the S&P 500 has in fact compounded at 9.1%, or it's gone up almost 900% in total return terms. But it is true that 58% of the time, the S&P 500 was going sideways to down. So there was no return at all 58% of the time. And as we go through the next few slides, you'll understand the significance of that data point. In this presentation, I'm going to cover what are cyclical economic trends and why they are so important. We'll also learn how to define a cyclical trend, and we'll also learn how and why assets perform so differently depending on the economic cycle regime. And lastly, I'll touch very briefly on how I go about spotting these critically important cyclical inflection points. So the majority of this presentation is going to be about cyclical economic trends. But before we talk about cyclical trends, we have to take a step back and build a foundation or start from the beginning. At EPB Macro Research, we take a very comprehensive approach, and we start all of our analysis by looking at what are called secular economic trends. Secular economic trends are 3 to 5 or even longer year trends that are basically completely controlled by debt and demographics, or debt and population growth. So secular economic trends are what we call economic gravity. So it's a huge disservice to yourself when you start a forecast or any kind of analysis without understanding where this gravity in the economy is. Is it pulling you down or is it pushing you up? Because you can defy gravity for a period of time, but you always end up returning back to that gravitational force. So secular trends are the long-term forces in the economy, and cyclical trends are the fluctuations in growth that occur around the secular trend. Now, for asset allocation and asset selection, we only really care about the cyclical trend, the 6 to 18 month cycle. But the secular trend is extremely critical, because if the secular trend is pulling you down, or gravity is pulling you down, which is the case today, then each cyclical upturn will be weaker and weaker, and each cyclical downturn will be longer lasting and harder to break. Now, this is clearly a sketch, but you can see that when the secular trend is down, that each cyclical upturn in this chart is getting weaker and weaker, or the economy starts spending less and less time in a cyclical upturn, and it spends more and more time in a cyclical downturn. So you don't have to take my word for it. This is the long-term trend in US real GDP growth. This is a 20-year annualized growth rate. So the last data point on this chart, 1.2%, means that real GDP per capita has only increased at a 1.2% annualized pace over the last 20 years, which is pretty bad. This is massively down from the 2.5% growth rates that we used to sustain in the 60s, 70s, and 80s. So the secular trend, or gravity, is pulling us down. We don't have too much time today to dig into why. This is something that I discuss at length in the premium EPB macro research subscription. But for now, all we have to know is that gravity is pulling us down. So the cyclical trend is where we want to focus. And we have to know that the bias for the cyclical upturns is that they're going to fade quickly, and that the cyclical downturns are going to last longer. So what exactly is a cyclical upturn, and what is a cyclical downturn? Very simply, when growth is trending higher, that's a cyclical upturn. And when growth is trending lower, that's a cyclical downturn. And just a couple of slides, we're going to see why basically everything rides on these cyclical trends in terms of asset class performance. And here's that stat again. Since 1996, the economy has been in a cyclical upturn only 42% of the time. It's been in a cyclical downturn 58% of the time. Now, just to reiterate, this does not mean, cyclical downturn does not mean negative growth. We're only talking about the direction of growth. So, for example, if growth moves from plus 4% to plus 1%, plus 1 is still positive growth, but the direction is moving lower. So that's a cyclical downturn. So instead of a sketch, let's look at a real live data point so we can see these trends in actual reality. Many of you may be familiar with the ISM Manufacturing Pmi. It's a very widely watched economic data point. If you're not familiar, that's okay. The ISM Pmi is simply a survey of manufacturing purchase managers. And when the reading is below 50, that generally means the economy is contracting. And when it's above 50, that means positive growth. It's a very popular data point because, as you can see, it's very cyclical, and it captures the cyclical trend very, very well. Again, a cyclical trend is defined by the direction of growth, not positive or negative growth. So as you can see on the right-hand side of the chart, we're very clearly in a cyclical downturn today. And it probably feels that way because the market's been persistently lower, and also the economy is starting to get a little bit softer. So the ISM PMI, while it's a very popular data point, it's not exactly how we define the cyclical trend, but I just wanted to show a popular data point that most people know to emphasize this concept of a cyclical trend. So how exactly do we define a cyclical trend? I don't like to do anything subjectively, so why not take the information straight from the NBER, the agency that actually dates these business cycles. They use a combination of basically 6 indicators to measure these trends. and when they date cycles or date recessions. And those indicators are real personal income less transfer payments, non-farm payrolls, which everyone knows, real personal consumption, retail sales, another employment measure, and industrial production. So what I do is I just take the data points that they just gave us and I smash them together into one index. This is proprietary to EPB Macro Research. I publish this frequently inside the service. And it tracks the growth rate. And you can see that it basically follows the same cyclical ups and downs as the manufacturing PMI shown in the previous slide. The economy moves in cycles. And it's not a business cycle that we're looking at here. It's a cyclical growth rate cycle. There's a big difference between a business cycle. We had one business cycle from 2010 through 2020. But as you can see in this chart, we had several cyclical trends that occurred within a longer business cycle. So these cyclical upturns or these fluctuations in growth, they last 6 to 18 months on average. Sometimes they can be as long as 3 years, but the average cyclical upturn is 13 months and the average cyclical downturn is 17 months. Why are the downturns longer than the upturns? That's that economic gravity that we were talking about in the beginning. The secular trend is pulling us down. So the downturns are lasting longer these days than the upturns. So we can pull this chart back until 1995, and we can see all the cyclical upturns and the cyclical downturns over the last 3 decades. This is my coincident index that I just showed, but pulled all the way back. The upturns are obviously in green and the downturns are in red. And we're about to see how this translates to asset performance. But since the data is so striking, you're probably not going to believe me, and you're going to think that I cherry-picked these start dates and end dates. I did not pick the dates of these cycles, these shaded bars. A third-party independent firm, the Economic Cycle Research Institute, actually dates these growth rate cycles. You can go to their website and you can see these cycle dates. They date both business cycles, which is a recession or expansion, and a growth rate cycle, which is what we're talking about here. And they do this for 22 countries. So you can pull the data from their website and you can test them yourself. So we're going to see now how the S&P 500 performs during a cyclical upturn and a cyclical downturn. The difference is really quite amazing. And this is the power of the economic cycle, or the power of these cyclical trends. So this is the S&P 500 since 1996. If you just bought and held it the entire time, it's got an annualized return of about 9.1% with volatility of 15%. These are the standard market returns that most people are used to. But what if we bought the S&P 500 and only held it during a cyclical upturn? And we held a money market fund during a cyclical downturn. So when the economy was in a cyclical upturn, we owned the S&P 500. When the economy was in a cyclical downturn, we sold and we held a money market fund. Well, the results are 11.3% annualized returns with 9% volatility. So you basically get all the returns with less volatility during the cyclical upturns. Again, these are dates that have been independently established. So what about the downturns? Let's say we held a money market fund during the upturns and we wanted to punish ourselves and only own the S&P 500 during downturns, the opposite of what we're trying to do. Zero return. There has been zero return during economic downturns over the last 25 years, but 12% volatility. So economic downturns, the S&P 500 does not go anywhere. It grinds sideways to down on average and has a ton of volatility. And during cyclical upturns, you get all of the gains of the market with less volatility. So now you can see that stat I had, or that trivia I had in the beginning of this presentation. The economy has been in a cyclical upturn 42% of the time, but over 100% of the market gains came in that 42% of the time. 58% of the time, the market has been going sideways to down. No gains, all volatility. Now, I probably know what you're saying, and I agree. This is very extreme because it implies that we perfectly nailed every cycle inflection point. And I am not suggesting that you can do that or I can do that. but that certainly is the goal of what we're trying to do. We're trying to capture all of the cyclical upturns and avoid all of the cyclical downturns. What I'm trying to show you is that these cyclical trends are basically the only thing that matters in terms of asset allocation or asset price performance. When you're in a cyclical upturn, you want to take risk, as much risk as you possibly can. You will be rewarded for that risk when growth is trending higher. But when you're in a cyclical downturn, you get all the bad parts of owning stocks with none of the upside. It's not just the S&P 500. We can take this beyond the S&P 500, and we can see how you can pick individual stocks with this type of a process. This chart shows the average excess performance of different sectors and style factors during cyclical downturns. I'm only showing cyclical downturns because we have limited time, and that's our current regime, so that's probably what most people are interested in. Everything in green means that on average, these sectors or style factors outperform the S&P 500 during downturns, and the red bars show you which sectors and style factors normally underperform during these cyclical downturns. Now, again, these are just averages over many, many cycles. So if you're a stock picker and you know that we're in a cyclical downturn, what sectors are you going to want to pick your stocks from? Probably healthcare, utilities, consumer staples. You don't want to be picking stocks from financials, industrials, and materials. On average, those are going to be your market laggards. So let's review what we've covered so far, because that was a lot of information. A cyclical trend is the 6 to 18 month direction of economic growth. And a cyclical upturn is when growth is trending higher, and a cyclical downturn is when growth is trending lower. When the economy is in a cyclical upturn, you want to take risk, as much risk as you can. And when the economy is in a cyclical downturn, you want to stay as defensive as you possibly can. So before concluding and throwing out a couple ETF ideas, I just want to cover how we go about spotting these inflection points or these pivots from downturn to upturn, because all the money's really made at the inflection points. Understanding where the trend is not that difficult. We want to understand where the trend is going. So in black here, we have our cyclical trend. This is obviously a sketch. And the data that defines this cyclical trend is called coincident data because it coincides with the cycle peaks and troughs. It defines the cycle. To get an idea of where the cyclical trend is heading, to stay ahead of the Fed, to stay ahead of most market participants, we need to look at leading economic indicators. And this is really the basis of my entire service, the study of leading indicators. Defining the trend is relatively easy. We want to know where the trend is going. Now, the study of leading indicators can get quite nuanced, and I don't have too much time to go into it in depth today, but we actually break these leading indicators into two buckets, longer leading and shorter leading indicators. And this gives us great confidence in knowing the future trend. Because if the economy is in a cyclical upturn, let's say, and I alert subscribers that longer leading indicators have turned down, we don't do anything with this information. We just are on alert that longer leading indicators have turned down. But then a couple months later, I tell subscribers that shorter leading indicators have also turned down. Now we start to make our switch in terms of asset allocation, or go from taking a lot of risk to taking less risk, because now we know that coincident data or the trend is about to flip as well. And the problem is that most people, including the Fed, only look at coincident data like employment. Everyone is still talking about employment. Employment is still strong. You hear all the time. But this is why they always miss it. They're not looking forward. We can have sharp declines in leading indicators, but if you're looking at employment and saying it's still strong, you're going to miss what's coming in the next couple of quarters. So inside EPB Macro Research, we watch this progression from longer leading to shorter leading data to coincident data, the data that defines the trend. And the coincident data doesn't tell you where you're going. It just tells you the current trend, which is why you need leading indicators. So let's look at the equation today. The cyclical trend is down. You saw that in the charts of the ISM PMI, as well as the coincident index that I posted. We're in a clearly defined cyclical downturn in the economy. Now, I didn't have time to go through the actual leading indicators. I just wanted to show you the process, but I can tell you that the leading indicators are sharply lower right now. So that means that the current downturn in growth that we are currently experiencing will not end in the next couple of months. And you have to add on top of that pretty extreme levels of monetary tightening from the Fed. And that cocktail gives you an extremely high likelihood of a recession in the next 12 months. So how do we play that? There's a couple ideas. The study of cycles tells us that long-term treasury bonds normally perform very well when the economy is in a cyclical downturn, because when you're in a cyclical downturn, the Fed is usually cutting interest rates. Now, this time is a little bit different, and the Fed has been raising interest rates, even though the economy is in a clear downturn. So long-term treasury bond ETF, TLT, has been falling as a result of these rate hikes. But as the economy gets closer and closer to a recession, which it is with each passing day, those rate hikes will have no choice but to turn to rate cuts in 2023. And TLT will try and sniff that out. It already is. If you look at the forward projections of the Fed funds futures market, the market is already pricing in almost 100 basis points of cuts in 2023. So I think that TLT will be a strong performer as we move closer to recession towards the back half of the year and into 2023. And it offers great value since it's been beaten down with these rate hikes as the economy goes into a recession. The historical data supports this as well. It's a great hedge to a portfolio that may be heavy in stocks if we're going into a recession. TLT can be quite volatile. So if you want the same basic trade with less volatility, IEF is a 7 to 10 year treasury bond, another security that will likely benefit as the economy goes into a recession and the Fed is forced to start cutting interest rates later in 2023. So TLT and IEF are two bond positions that you may want to consider to your portfolio as the economy continues to grind lower. They have not performed well year to date because of the rate hikes, but as these hikes flip to cuts, I expect that they will change their relative performance. Utilities is a sector that you should keep on your radar screen if you're more focused on the equity market. Utilities are traditionally one of the most defensive sectors of the stock market, and they've been holding pretty true to that description. The broader S&P 500 is down 15 to 20% year to date, and XLU's flat, actually up as of recording this. This is perfectly consistent with cyclical downturns. So I also like XLU as a relative performer as long as the economy continues to go down. If the economy does fall into a recession, there's a strong chance that XLU will fall in value, but it'll relatively outperform. If the economy goes into a recession, the earlier securities, the bonds, will probably go up. So this last ETF that I'm going to show is a little bit more outside the box. It's more of a fun ETF, but it's done really well this year. BTAL. It's a market neutral ETF. That means it has no directional exposure. And what the ETF does is it is long low beta stocks and it is short high beta stocks in a market neutral way. High beta stocks generally perform terribly during cyclical upturns. So this is a perfectly good ETF for the cyclical regime, and its performance has been very consistent with history. So this is, again, long low beta, short high beta. And as the economy continues to cycle down, I would expect high beta to underperform. And this is, again, market neutral. So we've seen very, very, very strong performance in this ETF. I would continue to keep this one on your radar screen as well, as long as the economy continues to cycle down, which is the forecast over the next couple of months. So remember this chart from one of the earlier slides. This shows the historical excess performance on average during cyclical upturns and downturns. And I just want to show how this is proving true again this cycle. If we take the top three equity sectors, now I'm just focused on the equity market here, the top 3 equity sectors that you want to be long of or overweight of during a cyclical downturn are healthcare, utilities, and consumer staples. The bottom 3 sectors that you want to avoid or be underweight during a cyclical downturn are industrials, financials, and emerging markets. So let's see how those have done year to date. Very consistent with history. The defensive sectors are outperforming the riskier sectors. So this is exactly how we can use these cyclical trends to pick sectors or even pick individual stocks within the sectors. Again, if you're a stock picker, you'll know which sectors that you want to focus on. So if there's one major takeaway from the slides here and everything that I just said, it's that when the economy is in a cyclical downturn, you want to play defense for as long as it takes, because it is not time to take risks. You'll be punished for taking risks. But when the economy flips to a cyclical upturn, which it will at some point, you want to take as much risk as you can tolerate. That's the time to swing big. You are rewarded for taking risks during cyclical upturns. So I'd love to take any questions that there are, but I'd just like to first suggest that if anyone found any of this information useful, they should consider the EPB Macro Research newsletter, because I give you weekly updates to the cyclical trend that I just discussed. So you'll always know what the current trend is. You also get access to my real-time ETF Buy List, which has basically all of the sectors that generally perform well on average during these downturns. All of my picks are a little bit longer term. They're for the 6 to 12 month view. So you get access to that buy list. I throw about 1 to 2 picks a month onto that buy list. It's only $99 for the first year for these weekly updates that you always know where the cyclical trend is. And then it's $199 every year thereafter. No price increases beyond that first year to second year jump because it's an introductory price. As a bonus, you also get a reference guide, an ETF reference guide, which has basically all the sectors and style factors and assets that perform well during each regime. So currencies, commodities, sectors, so that you always know which sectors to be looking at, what sectors to avoid. The full EPB Macro Research subscription is $9.99 per year. So the newsletter is a great place to get you a taste of what I do. It's got tons and tons of information on these cyclical trends and which sectors are best for the current regime. So you can take the newsletter subscription and upgrade if you find it useful to the full service. The full service has long-term asset allocation portfolios, a members chat room, tons of personal access to me for questions. We really chat all day long in that chat room, and I'm answering dozens and dozens of questions per day. The chat room is really a great place, but I encourage everyone to check out the newsletter if you are interested in having a real-time update on this cyclical trend, knowing where we are in the economy and what the regime is going to be going forward. So with that, if there are any questions, I would be more than glad to try and answer them. And I really appreciate everyone for listening to these slides here.
Eric, man, we really appreciate it. That was such a great job. I know my eyes were on the screen the entire time. I keep seeing one question that I want to get to real quick before all the other ones that keep coming through is people are wondering, they didn't really see it on your slides, but what do you think about energy? They didn't see the XLE. They didn't, is it under the commodities or where does that fall within the cyclical trend?
Yeah, good question. If you could, do you still see my screen here?
Yes, we can.
Okay. Yeah, so this slide here is a little bit abridged just because I couldn't fit everything onto one slide, so I had to cut it down a little bit. But yes, that is a really good question. And this is also an important point to make is that on average, these are averages across many, many cycles. There's been 10 cyclical upturns and 10 cyclical downturns over the last 30 years. So on average, energy tends to be a laggard. You don't want to be in energy during a cyclical downturn because generally commodity prices come down when the economy is faltering. There's a little bit of an anomaly this cycle, obviously, because of some of the supply chain constraints. However, I believe that by the conclusion of this downturn, this time's not going to be any different than the other ones. The only commodity that's really still standing of the broad commodities is oil. We've seen copper take a big fall. We've seen most of the industrial commodities take a big fall right on schedule as they were supposed to. But oil tends to be a little bit more lagging because while it is industrial focused, it actually has a huge service sector component with people driving and airlines. So oil tends to fall after the industrial commodities like copper. I track other things like zinc, rubber, rosin. Those commodities are exclusively industrial commodities, and they always fall first. So energy tends to move very late, very, very late in the cycle because of oil. So yes, energy has been a good performer so far, but by the conclusion of this downturn, I do not expect this cycle to be any different. I expect the cycle to drag oil down as the economy moves into a recession, and therefore the energy sector would come down. But it's not on this chart, but yes, as a general rule, on average, you want to be long of energy related equities when the economy is moving higher, when the economy is accelerating, because that's generally when your commodities are rising in value.
Thank you for clarifying that. I think there was a handful of people that were wondering about that. And we actually have another group of people, since we're on this slide, why don't you guys just leave the slide up, that they're asking, where does the technology sector play during a cyclical downturn trend? They didn't really see the sector illustrated in your side. Are you including that in growth?
Yeah, so I excluded the technology sector because I wanted to add some nuance if the question came up. So I'm glad that it did. So yes, growth generally means technology. So growth or technology generally tends to perform well in the cyclical downturns on average. But I want to make a huge distinction for technology because the growth ETFs or the growth sector is really dominated by, let's say, like Apple, Microsoft, Google. These are the sectors that really dominate growth. And during a cyclical downturn, those sectors will perform well. They are interest rate sensitive, so it's the same concept as the long-term treasury bonds. Normally, they perform really, really well, but this has been a different cycle because the Fed has been hiking rates into a downturn. That's putting pressure on anything that's sensitive to interest rates. But again, at the conclusion of the downturn won't end until we have a rate cutting cycle. So the long-term bonds will gain their performance back as the Fed cuts because the cycle won't end until they cut. And then the growth and technology will also regain their outperformance as the Fed cuts. So technology is on the left side of this screen. It is a generally good performer during cyclical downturns. But again, I mentioned the big mega cap technology. That's where you're going to want to stick. The ARC type stuff, that stuff doesn't always perform so well in a cyclical downturn as the economy goes into a recession. So you have to split the technology sector between big mega cap conglomerate tech, that gets a check for the cyclical downturns, and then the ARC type stuff, the speculative tech, that doesn't get a check during the cyclical upturns. Now, I know that the technology sector writ large has not performed well, but again, that's because of the rate hikes. And as rate hikes flip to rate cuts, then the technology sector, specifically those mega cap conglomerates, will show their outperformance during this cycle.
Eric, let's piggyback off that with the tech that you're talking about with ARC and everything else not accurately represented. We had a question come through asking if the NASDAQ was still an accurate reflection of current technology and AI stocks, given digitalization lagging representation in the GDP. They were just kind of curious, what were your thoughts on that, if you had any?
Yeah, I think so. I mean, the NASDAQ is basically dominated by those big companies, Microsoft, Apple, Google, Amazon, Facebook, and I think it still does capture a pretty good representation. I mean, the question's a little bit outside of my wheelhouse. I'm not an expert in the automation and sort of the AI type stuff. I'm generally focused on these bigger macro trends, but I think that the technology sector, the NASDAQ, still does do a pretty good job. I mean, you could probably find individual indexes that try and do a better job of specifically capturing some of that automation. But for the general trend, I think that these big mega cap conglomerates still do capture that trend because that's the benefit or the advantage that they have, especially in a lower interest rate environment, is that they have access to capital markets that they can just borrow and buy. the growth or the automation that they need. And we send these companies are serial acquirers of smaller, more innovative companies. So I do think that ultimately a lot of this new age tech filters into these big companies in one way or another, whether it's a subsidiary or a fully owned entity.
Oh, that's great. I want to go ahead and tee you up with a two-parter. We had somebody on this chart specifically. I think a lot of people are looking at this, and somebody pointed out value has been beating growth lately, hasn't it? Question mark. But according to your chart, it should be down more than growth because they see value on the right side at negative 2.5 with growth obviously on the left side 2.4%. And then the follow-up for that is I think Jorge. I'm sorry if I'm pronouncing your name wrong, but he's asking what is included in value. So if you might give him a little insight.
Yeah. So good question. So again, by the conclusion of this downturn, I believe that value is going to underperform growth. We're only halfway through this downturn, so we can't judge the performance of this downturn yet because we haven't seen the end of it. And the only part of this downturn that we've seen is the rate hikes. And the rate hikes disproportionately impact assets that are sensitive to duration, which means technology, which means bonds, which means growth. So that's why we've seen the growth stocks underperform in this first half of the downturn. Normally in downturn, rate hikes never come. Rate hikes only come during upturns, which is why the performance is stacked this way. But this downturn will not end until we have a rate cutting cycle because the momentum of the economy is moving lower and the Fed is pushing us down the hill even faster with these rate hikes. So we will have to go through a rate cutting cycle in order for this downturn to flip to an upturn. And when we do go through that rate cutting cycle, value will massively underperform growth. And I believe that the conclusion of the downturn will end up being representative of this chart. But yes, up until this point, growth has underperformed value, but that's only because we're halfway through the downturn. We can't judge the performance until it's fully done. And it's because that the first half of the downturn has come with rate hikes, which is historically very inconsistent. The value sector or value style factor, to take the second part of the question, is generally composed of all of these sectors that you see on the right side of the screen, which are the materials, the industrials, the energy, the financials, your economically sensitive sectors, and your growth is really your technology. So that's the split between the two of them. So yes, I fully recognize that growth has underperformed value so far, but we are in the middle of a downturn. We're not at the end, and we haven't seen the rate cutting part of this downturn, which is the reason growth outperforms value in a downturn.
Yeah. Good insights. Want to follow up on that as well I want to get to a couple more of these while we're on this slide. We saw a handful of questions come in, obviously, about the energy complex, which we touched on a second ago. And now we also have this question about gold. How do you think gold is going to perform during the downtrend? Does that fall under your commodities as well?
Yeah, another good question. So I separate commodities into kind of three different commodities. We have gold, we have industrial commodities like copper, zinc, all of your really base metals, and then we have oil, right? So gold may decline in a cyclical downturn because if the economy goes into a recession and you get a whiff of deflation, gold may go down in value. However, gold will outperform your base metals, your copper, your zinc, your aluminum, and it will outperform oil most likely in a recession. So when the economy is trending down and it's going into a recession, I like gold. Gold is a good exposure. Even though it may decline in absolute terms, it outperforms in relative terms. So I think that we have to split the commodity bucket. Gold is sort of your very stable foundation. Then you have your really economically sensitive industrial commodities like copper, and then you have oil, which is service sector based. Gold should outperform the rest of the commodity complex, even if it's falling in value. So for example, Gold is down. I think the last time I checked 2 or 3% year to date. It's not positive, but it's outperforming something like copper, which has declined 30% in the last month or so. So that's very consistent. So gold, good asset in relative terms, may decline in absolute terms, but it should hold up better than the rest of the commodity complex.
Eric, let's this is devil's advocate. This also came through pretty much based off of what you just said about, the cyclical nature of the economy. We're seeing all the commodity prices that are extremely volatile right now, right? Like take liquid natural gas with all the stuff going on in Europe or the supply chain issues that we've had. I think some people are wondering, with the lack of supply and demand still high, the prices have to go up. So how are commodity prices coming down? Is that just based off of the downturn in the cycle? Are you expecting those to come down, or what's your opinion on that?
Yeah, I mean, we've seen the industrial commodities come down in price, despite, we hear a lot, like, when copper was rising and the economy was starting to turn down, all we heard was copper is not going to go down this time because EVs and EVs are going to cause us to have so much more demand for copper than it was previously. So copper is not cyclical anymore. And of course, give it a couple of weeks, a couple of months, and boom, copper goes down 30% just with the cycle. So I'm not discounting the supply issues. There's certainly supply issues, but you think about something like wheat also. A supply issue was caused by the invasion of Ukraine. Wheat prices went sky high. Everyone said, we're only going up, up, up. And all of a sudden, wheat prices are lower than they were before the invasion. So supply is a very important factor, but supply tends to be a slower moving variable than demand. Demand tends to be the swing factor for most of these commodities. So as growth continues to move lower and lower and lower, and the economy goes into a recession, you can see the change in demand will be much more rapid than the change in supply. So I'm not saying supply doesn't matter, but when you're looking at what's going to move the price of the commodity on the margin, it's almost always going to be the demand because it can just change so rapidly. So for example, we have a supply demand curve with oil. People will say maybe we're 1 million, 2 million, 3 million barrels, let's say, undersupplied. But you go into a recession, you can knock 4 million barrels off demand just like that. It's really difficult to change supply that rapidly. So demand tends to be the marginal swing factor in the price of these commodities. And we heard it with the industrials. We heard that the industrials weren't going to go down this time because supply was constrained. And just like that, 30% in a month, copper's now trending down. Almost as low as it was in 2018, 19 again. So I think that, yeah, supply is a factor, but demand is really the swing factor here.
Yeah, I mean, hence the interest rate hikes, right? Crush the demand since you can't control the supply. Now, I want to move on from like commodities and those sectors that we were talking about and touch on a couple of different investment classes as well. Like, for instance, this question came through. What would you be thinking about, real estate investment trusts or just real estate in general during these cyclical downtrends like right now?
Yeah, great question. And real estate is another one that's quite nuanced. Financials is less nuanced, right? When growth is trending higher, all financials tend to do well. When growth is trending lower, all financials tend to do poorly. The real estate sector, you got to look at a little bit more nuanced. And I don't love the real estate sector because there's no great ETF that breaks it down. It's all bucketed into one large REIT ETF for the most part, at least the big liquid ones. And you have to think about what are the different components of these REIT ETFs. You have something like residential apartments, you have storage, you have cell tower. Those tend to be more defensive in nature. So those sectors can perform better during a cyclical downturn. But then you have stuff like hotels, malls, mortgage REITs. Those obviously are much more tied to the economy. So those tend to be really cyclical, and those tend to perform really poorly during cyclical downturns. So the REIT sector is interesting and requires some nuance because you have some subsets of the REIT sector, mainly the cell tower, the storage, and some of the resi apartments that are a lot less cyclical. But then you have some wildly cyclical parts like the malls, shopping centers, hotels, things like that, and mortgages that you got to be careful of. And that's why when you test the REIT ETF on a back test over these cycles, when you do an upturn or downturn versus financials, you get a huge green bar during upturns and you get a huge red bar during downturns. The REIT one tends to be a little bit more clustered in the middle without huge disparity because there's so much differences under the hood. So if I was going to play the REIT space during upturns and downturns, when we're in a downturn, you want to stick with these subcategories of the REITs that are most defensive. But when you're in an upturn, you want to stick with the subcategories that are most cyclical, most offensive.
Yeah, that's awesome. Hey, can you do me a favor and actually go back to the slide that showed the S&P 500 and investing in that? Wait, there it is, right there in the uptrend versus downtrend, or just over time. I want to go ahead and run another poll for everybody that's with us still. I mean, all the real ones that have stuck around with us this long. Just want to ask you this question and kind of get a gauge from everybody who's still here. Do you take economic trends into consideration before investing into an ETF or a stock? So go ahead and look at your screen real quick for us. Go ahead and leave your response. Yes, of course. No, I never have. Or, some of you may have learned something new today as Eric was presenting. And now you're like, oh, I should now really look at the economic cycle because look at the difference in the returns between catching the uptrends. Obviously, you don't want to catch the downtrends. That doesn't look friendly at all. Let's give another here second or two.
Yeah, well, everyone's voting. I mean, you think about what's been happening recently, Daniel, right? Like, so we've been in a downturn for the past year, and what's been the result? I mean, it's been all chop, no return, and a lot of stress, right? So we've been in a downturn. You want to be playing defense because this is just what happens when the economy is cycling down and growth is declining. By definition, you're moving closer and closer to a recession, right? And we're hearing companies talk about this now. This was all stuff that was totally forecasted by the leading indicators over a year ago. And we're seeing companies, reduce their guidance now. So I believe that this stuff's going to continue, and the major gains in the market will come again when the economy rebounds and starts accelerating. And I think people really get hung up on the fact that, hey, growth is still positive, but you got to remember it's all about direction. It's all rate of change. Are we accelerating or decelerating? That's really the critical point.
That's so true. So I want to go ahead and move on. Thanks for everyone for participating in that poll. Let's move on to what is your take on geopolitical events and how did those impact the economic cycle?
Obviously, good question. Can't ignore that one. But my process is very focused on economic data. So if I go over here to this slide, let me see here. If I have my leading indicator slide here, everything for me is these leading indicators, right? I have a coincident index, which I showed earlier here. This coincident index defines the trend. We know that the trend is going down. The growth rate is decelerating. We don't know where this is heading, though. The coincident data doesn't tell us where we're heading. The leading indicators tell us where we're heading. Now, I'm not a geopolitical expert, and I do not speculate on anything that I don't know. And I don't speculate on anything that I don't have concrete data for. So the way that I answer all of these questions, people always say, well, what about the Fed? Well, what about geopolitics? I think it's a huge problem when everyone starts to opine on what's going to happen with geopolitics, or what's going to happen with domestic politics, or what's going to happen with the Fed, because these are just sort of subjective opinions. All of these things at some point will come through my indicators. Actions that the Fed takes impact our monetary and credit aggregates. Monetary and credit aggregates are part of longer leading indicators. So instead of me speculating on what I think the Fed did, I just look at how it impacted the leading indicators. How did the geopolitics impact our current situation? Well, how is it going to impact the data that's part of the longer leading or shorter leading bucket? That's really how I answer all of these questions. I do not opine on what I think Russia's going to do. Are they going to pull out? Are they not going to pull out? Are they going to, or what the Fed's going to do? We just end up making huge errors when we put our biases into it and we say, I think I know what the Fed is going to do or not do. How does it impact the leading indicators? Leading indicators include all of these things that the Fed drives: monetary aggregates, credit aggregates, interest rates. It all comes through the data. So If it comes through the data, that's how I interpret it. And all of the Fed actions are very clearly pushing the leading indicators lower and lower and lower. That's how I interpret that the economy is going to continue moving to the downside. So it's much more of an objective process versus my subjective opinion. I know people, may come to trust the opinion that I have, and that gives me a license to opine on areas that I'm not an expert on. But I don't think that I'm worthy of that. I don't think that it's fair to say, I have a group of people that are following me, therefore I can speculate on all issues across the board. I just let it come through the leading indicators, and however it impacts those is what's going to determine my future outlook.
Yeah, you teed this up perfectly too. Since we're here on the longer leading, shorter leading on this slide specifically, we had a question come through. I wonder if you might answer this for them. What would you hail as the top 3 factors or leading indicators to look for that would signal a flip from downtrend to uptrend?
Well, they're asking me to give away the secret
Pretty
sauce.
much.
No, yeah,
I'm
only kidding. I'm only kidding. Yeah.
You got to try.
Okay, I'll break it down this way. From a very high level, we have our coincident data, the black line, which is defined by income, consumption, production, and employment, right? You think industrial production, non-farm payrolls, real retail sales, that kind of stuff. That's your coincident data. Your longer leading indicators tend to be your monetary aggregates, your credit aggregates, your rate of change in interest rates, whether that's mortgage rates, corporate rates, treasury rates, and the housing sector, all of your housing data. And remember, with the housing sector, you have to differentiate volume versus price. Price lags volume. So today we saw new home sales, the volume of transactions, implode, down 30, 35, maybe even more at this point, maybe down 40% from peak. So longer leading is monetary aggregates, credit aggregates, rate of change in interest rates, and the volume of transactions in the housing sector. Shorter leading indicators are things that those variables impact. So you think new orders of durable goods, you're thinking about sort of your industrial metals, manufacturing sentiment, things like that. So that's sort of how I would answer those are the areas you want to be looking at without giving you the exact indicators, since those are exactly what I talk about every single week inside of my service. But that's sort of the framing of how you should think about the progression from longer leading to shorter leading to coincident.
While you said that, well, let's talk about that a second, because a question came through as well. They're asking, does your service track these things? Of course they do, but how do you notify the people within your service of the changes of these indicators as they change over time?
Yeah, so in the full service, we're talking about this stuff basically every single day in the chat room. Every time a data point comes out, I'll note there's a longer leading indicator. This is what the data point was. But I also basically cover this in one monthly report. I have a monthly cyclical update that comes out once per month in the usually the second week of the month. And even though I provide intra-month updates in the chat room and some weekly stuff here and there, I have one big report that encompasses the entire thing. I outline what the cyclical trend is. I go through the longer leading indicators. I go through the shorter leading indicators. I make the forecast of what that means, what we're going to be, where we're going to be headed going forward. And then I also say, given that outlook of where we're going, here are some ETFs to think about on the long side. Here are some ETFs to think about on the underweight or short side. And that's sort of how I go about it. So I do update this stuff on a weekly basis with some very, very quick blurbs and some quick, couple paragraphs every week. That's sort of what I provide on the newsletter, is those short weekly updates. But the big meaty update where I take you through the whole process, start to finish, every single month, is in the full service, and it's just one monthly report, and it's one cohesive piece, starting with the coincidence cyclical trend. Here's where we're at right now, going through the longer leading, all of them, going through the shorter leading, all of them, and then letting us know where we're headed going forward.
Yeah, Eric, go ahead and do me a favor. Go to that last slide you had as well that covered your newsletter, and just go ahead and put that up. I know we're getting to the end of time here. We want to be respectful of everybody's time today, and we really appreciate. That's not the slide, is it?
Oh, no,
keep going to the last one. Yeah. We want to be respectful of everybody's time. Great. Obviously, everyone, thank you for coming and tuning in. There were so many questions that we couldn't get to. So, Eric, I wanted to ask you, obviously, people that get into the service can talk to you and ask you questions and send you messages. But if they don't join your service, is there a way for them to get in contact with you?
Yeah, so on Seeking Alpha, you could send me a message on my profile. Just go to my profile, my author profile. You can send something directly to my inbox. More than happy to answer any questions that you have about the service or about economic cycles. I'm really open to talking about incoming messages. I like to inform everyone about what I think is going on and sort of teach the process a little bit, because there can be a little bit of a learning curve. So you can hit me on the Seeking Alpha inbox anytime. Or you can find me on Twitter, EPB Research on Twitter. My DMs are open there, so you can send me a direct message there if you happen to be on Twitter. And then if you want to take a free trial of the full service, the chat room. The chat room is really where I'm at most of the time. So that's those are the three places to find me.
That's awesome. And just a reminder for everybody that's leaving in the chat, there's a ton of thank yous for you, Eric. I mean, there's people saying that they learned something new today. Great presentation. Just a reminder for everyone that this will be sent out to you for a replay afterwards as well. So you can rewatch this and go over any information that you might still feel like you might have missed, or if you tuned in late or anything else like that, that will be sent to your email inbox as well. The link will, of course, be there for you as well if you didn't capture it in the chat box today. Eric, we appreciate you so much. Like I said at the very beginning, you've helped me protect my portfolio, and I can't thank you enough. So thanks for helping everybody else out. And any last words?
No, thank you. Thank you, Daniel. Thank you, Seeking Alpha. Appreciate everyone who took the time to come in and listen to this. And please do send me a message. Really happy to answer any questions that you guys have. So thank you.
All right, everyone. That ends it for today. Watch out for the Fed tomorrow, and we'll see you next time.